Aye, present.
Deputy Mayor Cashmore.
Hello.
Councillor Bartley. Councillor Casey. Councillor Collins.
Kia ora, Sandra.
Thank you. Councillor Combe.
Kia ora no.
Councillor Cooper.
Here.
Councillor Dalton.
Present.
Councillor Darby.
I'm here.
Councillor Filipino.
Hi.
Councillor Henderson.
Hello, everybody.
Councillor Hills. Councillor Mulholland. Councillor.
Sandra, I couldn't get my mute in time.
Oh,
Apologies.
thank you, Councillor Hills. Sorry, I'll just call Councillor Mulholland again. Thank you, Councillor Sayers. Councillor Stewart.
Sayers present, sorry, slow on the
Thank
button there. Okay.
Yeah, I'm present.
Thank you. Councillor Walker.
Happy St Patrick's Day.
Councillor Watson.
Present.
Chair Taipari.
Kia ora.
Councillor Young.
Present, thank you.
Thanks,
Thank you,
Sandra.
Madam Chair.
Right, people, now we go into item 10, which is our council group and Auckland Council Parent quarterly performance report for the 6 months ending December 2021. And I invite Karuna to introduce the item. Look, I've got a number of chairs recs which I'll go through afterwards, which are just really highlights and facts from the report. But Karuna, over to you first.
Thank you, Madam Chair, and kia ora, everyone. So yes, we'll present the second quarter report, which covers the 6-month period up until December 31, 2021. So we have Ross Tucker, who will cover off the headline group results, and then we'll switch over to John, who will talk through the debt results. John will also provide some extended coverage of the first offshore green bond issue and some information on sustainable link loans. We will then move on to Nicola, who will cover the AC parent financials, and I'll briefly go over some performance measure results and key highlights. Following this, we're pleased to welcome Dr. Claudia Weiss, Director Customer and Community Services, who will present a brief summary of the customer and community services affected by the Omicron outbreak, the resulting impacts on service delivery and associated cost pressures. So we will kick off and hand over to you, Ross, the group results.
Thank you. So this is the group results, group performance results through to end of December last year. We've already had reported to you the interim results. So that's the external statutory reporting for the same period. The focus there is essentially how did we go compared to the prior year, whereas the purpose of the performance reporting is how did we go against the first 6 months of the recovery budget, including all the things we said we were looking to try to achieve in that budget. How are we going? Are we on track or not? I guess the short answer is not obviously not on track in the way we hoped to be, because that 6 month period had 3 months affected by lockdowns. So a pretty tough operating environment because of the lockdowns over that period. We knew in the recovery budget that there was lots of uncertainty and risk around these things, and risks around broader pressures such as interest and inflation. We have over the 6 month period seen some of those things start to bite. We've had ongoing COVID uncertainty. This was largely affected by Delta and lockdowns, and what's emerged since then is the emergence of Omicron, and that will affect us going forward. But we are, through these results, starting to see the impact of supply chain challenges, labour shortages, rising costs, rising inflation start to hit, and it's evident in these results. So what does that mean? That means hits to revenue, it means delays to many or most of our construction projects, and increased costs, rising costs. So this is kind of the beginning of some emerging trends. Unfortunately, it's not going to be the end of it. And next month we'll be reporting to you about an update on the annual budget for next financial year. And so this is the start of some of these trends that are going to become more and more challenging. But if we go into the results for this 6 month period, if we go to the next slide, please, and focus first on Capex. So the group delivered a 917 million Capex for the 6 months compared to a plan of 1.3 billion. So it was a 68% delivery. compared to the same period a year ago. We were delivering 93% of the budget, but because of the lockdowns and all of the disruption, we achieved just under 70%. So not a bad outcome in the circumstances, given the environment. Obviously, it was less almost 290 million less than the prior year, 24% less. But in the circumstances, delivering over 900 million and 70% of budget is quite an achievement. So what was delivered? So some of the key highlights: the Waikato Boost Pump Station. So some of those key initiatives around boosting water supply were enabled. Eastern Busway, key milestone there, reached on the 18th of December with the first stage of that opening. And there's a number of other projects as well. West Coast Road Safety Improvement Project as one key example, and that's been highlighted by Wakakotae as a national case study of how to do good road safety projects. So a few key highlights there. But on the flip side, what was delayed? And that was many things. So many asset renewals, particularly stormwater space, work smart, so some of that stuff within the property activities, central interceptor delayed, and some of the other water keys big projects such as the Huia number 1, Manukana Link Drive, many other transport projects, and then Transform Manukau, Panuku's project there, and the film studio, affected by COVID and delayed as well. So many examples of things that are, we've made, some progress, but things are behind schedule, which you'd expect given the lockdowns. If we go to the next slide, so thinking about OPEX. So overall, if we kind of take out the interest depreciation and take the view of direct revenue and direct expenditure without interest depreciation and some other account adjustments, essentially we were almost bang on for the 6-month period. In fact, we were just a small, but it was 8 million ahead of budget. So in small net favourable if you just look at the numbers. But I guess what that doesn't tell the whole story. We had both revenue and expenditure below budget. So overall, direct revenue for the group, 35 million unfavourable to budget, and that was just slightly more than offset with reduction in spend. The problem with that, it sounds on the face of it sounds good, but that revenue is essentially lost. It's money that didn't come in the door, but a lot of the spend are things that are delayed. It's deferred maintenance, deferred work programs. So we'll have to spend that OPEX at some point, whereas the revenue's gone forever. So while things matched off, it's going to come back to bite in the future. So I guess just drilling into the revenue picture, there were some improvements. Infrastructure growth charges, it was 31 million ahead of budget. Regulatory revenue 18 million ahead of budget. So that helped mitigate some of the revenue loss, but overall it was down. And the biggest driver there was public transport and parking revenue, 51 million adverse to budget. But we also had community facilities, events, venues for hire. They were closed or events cancelled. Lack of money coming in through the door, and that was about 26 million lost through those channels. Also, some water and wastewater revenue charges down by about 30 million. So overall, a lot of revenue we didn't collect through the lockdown. And going forward, the picture looks a bit different. It's not about Delta and lockdowns, it's about Omicron and facilities being closed, people avoiding public transport because of the Omicron circulating in the community. And then who knows what's beyond that. On the expenditure side, what were some of those reductions? It was largely delays in work programs. That was 33 million less cost for things being delayed, but those costs will come later as we catch up on things. There is the cost of some of the events, so we didn't run events. We closed some facilities. We didn't run as many PT services, and that reduced spend by 28 million. So some of that is net mitigation, and we won't catch up. But there's a lot in there that is just delayed. Some of that, within that spend side, there was some extra staff cost spend for water care in particular, and that was largely water care having to employ more staff to keep people distanced to get on with providing critical services while keeping everyone safe. If we go to the next slide, please. So looking at FTEs across the group, So because this is the result, this is the position as at the end of December, there's always a seasonal pattern in here. We do employ more staff over the summer months. If you think about extra park rangers, lifeguards, other people running programs in our leisure centres, rec centres, etc. So there was that kind of normal seasonal peak as part of it. So overall across the group, 381 extra FTEs for that period, the larger number within the council. That included 67 seasonal extra employees, and then the rest of it was largely filling vacancies. It has taken time to fill vacancies given tight labour markets. Water care also had a large number there. There's a range of different projects. Some of it is Three Waters staff and backfilling some people that have been seconded and involved in working on the Three Waters issue. Lots of other things, revenue assurance processes. There's the Lutra subsidiary, work on AMP and some digital improvements. So across a wide range of activities have geared up and it's required extra staff in water care space. AUL has had filled some vacancies, largely around animal science and some digital project at the Maritime Museum. What else? Ports, 26 extra FTEs at ports, and that is the operational side of things. That's operational staff, that's stevedores, that's more people to work offloading ships to deal with the congestion and issues faced there. So more staff to actually get goods moving. Auckland Transport have a small increase there, largely driven by delivering projects from the Regional Land Transport Plan, and also some procurement staff that are working on that have been created as part of a procurement centre of excellence. So it's staff to deliver projects and procurement related to projects. So that's a picture of the FTEs and what's driving some of those increases. Some of them will be temporary, some of them more permanent, but most of it is the permanent increases are about delivering more activity. If we go to the next slide. I think last one from me. So just, where to from here? So the uncertainty continues. Got the ongoing COVID-19 impact where we have got, concerns not so much about lockdowns, but it's staff absenteeism, people changing their behaviour, people staying away from public transport, etc., people staying away from our facilities. We've got those unfavourable trends, inflation. We've seen that, CPI at 5.9. People expecting the next number to be even higher. Fuel prices, we all know where that's heading, where that's gone to, where that's heading. Supply chain challenges, labour market, borders will hopefully open up and we'll get more people in, but at the moment, very, very tight to get people in, and supply chain disruptions will continue for some time. So that's all on top of all of the existing risks we have. We've got to achieve that 90 million savings target, and as Nicola will tell you shortly, we're making good progress on that for this year. But the challenge there is we've got to achieve 90 million next year and the year after and the year after that. Also, the asset sales program, surplus asset sales, as you've talked about this morning, it's challenging. There's a risk there, and we'll need to work hard to achieve those targets. So we've got to achieve those targets and then deal with all these other things that are coming our way. So at the moment, we're monitoring those things closely. We're maintaining a strong focus on long-term sustainability, pathway to recovery, managing these risks, but it's shaping up for some pretty challenging situations for next year's budget, and you'll hear more about that next month. So with that, I'll pass across to John to talk about the debt slide, the debt picture.
Great. Look, thanks, Ross, and good afternoon, everybody. Look, I'll start with a picture of our debt. Our net debt as at the end of December 21 was 10.5 billion. So that was a modest, about 100 million increase over the figure as at the end of June 21. And that was largely a reflection of the slowdown in capital delivery, which Ross has talked about. Now, focusing on a couple of the key ratios which the rating agencies look at. The first one there, the after capital deficit ratio. Now, just to remind you what that is, that reflects our level of operating expenditure plus capital expenditure and compares that to our level of operating revenue and capital revenue. So things like capital subsidies we receive from government. Now, as long as that ratio of operating expenditure and capital expenditure doesn't exceed our level of operating capital revenue by more than 20%, and that's calculated on a 5-yearly average, that's consistent with a AA rating. As you can see, we're at minus 14.9%, so within that target of better than minus 20%. If we turn to our debt to revenue ratio, now just a reminder, that's gross debt to revenue, so it doesn't net off cash. Now this is quite elevated at the half year, and that's simply due to the fact that we had a large debt capital raising before Christmas, where we issued close to $1 billion New Zealand dollars in a foreign currency euro green bond. We'd expect that debt to revenue figure, so that gross debt to revenue figure, to move back towards that budget level over the remainder of that of this financial year. And just a reminder, the limit there is at 290%. Now, just note there has been talk in the media over the last couple of weeks about council's debt levels and the implication that we have too much debt. Now, I'd respond to that in saying that, I still believe we have a prudent level of debt given the size of Auckland Council's balance sheet. And I sort of evidence that by two factors. One is if you look at our sort of net debt to assets ratio, so that's, I guess, a basic measure of our leverage or gearing. That's sort of remained around the 17 to 19% area, has remained so for the last 4 or 5 years, and is in fact predicted to remain around those levels going forward. And I guess the other point is that, look, we've maintained our ratings from S&P and AA, and Moody's at AA2. Now, if they thought we had too much debt, we certainly wouldn't be at these strong rating levels and with a stable outlook. Just turn to the next slide, please. So now I'll spend a few moments updating you on our activity in the sustainable finance area. So look, firstly, green bonds. So just a reminder that when we raise money through green bonds, it is just like when we raise money through any other normal, say, vanilla bond, except that the proceeds must be invested in sustainable assets. And these are defined by our eligible assets, as you can see on the right-hand side of this chart there. So what we're doing with these funds, we're investing in things like low carbon transport, sustainable water management, efficient buildings, etc. Now, we were the first New Zealand entity to issue a green bond back in 2018, and now we have 5 outstanding green bond issues, totaling almost $2 billion. Our most recent issue was our first green bond issue issued in a foreign currency, and that was the Euro 500 million issue that we completed before Christmas last year.
Brilliant.
Just the next slide, please. So we've now undertaken what is called a sustainability-linked loan with ANZ. Now, what that is, that's just like a normal loan, except the margin that we pay on the loan depends on our performance against some predefined environmental, social, and governance objectives. Now, if we meet those objectives, we pay a slightly reduced margin, and if we fail to meet those objectives, we pay a slightly higher margin. Now, for this sustainability-linked loans, our targets centred around diverse procurement, reducing our bus fleet emissions, and reducing our overall greenhouse gas emissions. Now, these targets need to be ambitious. They're beyond business as usual targets, and like our green bonds, their performance is subject, or our performance against these is subject to external review and regular reporting. Now, in addition to undertaking a sustainability-linked loan, we've now undertaken our first sustainability-linked derivative, again with ANZ. Now, just a reminder what a derivative is. That's an instrument we use to fix our interest rate exposure, often called interest rate hedges or interest rate swaps. So a sustainability-linked derivative is just like a normal derivative, except again, the fixed interest rate we pay depends on our performance against predefined social, environmental and governance objectives. Once again, if we meet our objectives, we pay a slightly reduced fixed rate, and if we don't, if we fail to meet our objectives, we pay a slightly higher fixed rate. And for our first sustainability-linked derivative, our targets are exactly the same as our sustainability-linked loan. So I'll leave it there and pass over to Nicola to talk about the parent results.
Thanks, John. Next slide, please. So the performance of the council parent is very consistent with what Ross has given an overview on for what is happening at the group level. our capital performance, you can see we delivered 116 million worth of projects in the first 6 months. And I think it is worth calling out the things that we have managed to progress, and there are some renewals projects that are listed there, Meadows Farm, Victoria Park, etc. We have, of course, faced significant headwinds in trying to deliver the projects, and that's due to a range of things, material shortages, staff shortages, but also some of the projects, particularly in the Development Program Office, City Centre space, have interdependencies with larger projects such as the CRL. And so, we face delays if other projects face delays as well. And as much as we have taken a lot of mitigating steps to try to work with suppliers and get things planned early, it is a tricky space. Claudia may be able to talk to that a little bit more later. In terms of operating results, next slide, Hannah. As Ross also said, our operating results, the financial results look great. Our revenue is favourable to budget and our costs are below budget, but it does really belie what is a very challenging environment operationally. So we continue to see the high levels of consenting activity, which is why our revenue is overall above budget. It is offset by reductions, particularly in the leisure space, with a lot of our leisure facilities either having been closed or with lower visitation. And so, yes, we are also saving costs, and I'll talk soon about where we're at in terms of the savings target. But it has been challenging to recruit enough staff to deliver our programs, and some of the high volumes of work that we face in the regulatory area. So in terms of savings, we've made good progress on the 90 million target, so we are just above 70 million at this stage, just over 78%. A lot of that has come from underspending our budgets, one-off savings in the current year. However, we do continue to make procurement savings by contract negotiations, which will have an ongoing benefit. And we also had a good look at whether we really needed to send out printed rates notices every single quarter to all of our ratepayers, and have been able to, at this stage, stop sending them to people who pay by direct debit. And we're looking further at other customers and whether we need to keep sending those notices every quarter. Of course, we do send the first one at the beginning of the year. So we are on track to achieve the target this year. And we'll have an update. The next update will be to the VFM committee next month. It is a struggle, though, to make lasting savings that will contribute towards our targets for the next couple of years. So we're at around 52 million at this stage. And I will hand over to Karuna now, who will talk to some of the non-financial performance measures.
Thank you, Nicola. So in Q2, 26 performance measures were updated. And in a similar vein to the financial results, COVID-19 and the associated challenges continue to impact performance measure results as well. And as you can see on the screen, 11 performance measures did not meet target, and COVID-19 had either a direct or contributory impact. These included, for example, some regulatory measures, given things such as on-site inspections could not be done during COVID-19 restrictions, visitor numbers to our libraries, and participants in activities at our community facilities. However, as we move through the different settings of the COVID-19 protection framework, we were able to ease restrictions with a safe, staged reopening of facilities and services, whilst also considering staff safety and wellbeing. And Claudia will speak further on this shortly. The flow-on effect of COVID-19, as Nicola mentioned earlier, around the increasing volumes, and complexity of consents, plus the challenges around staffing, continued to place pressure on our statutory processing timelines. In terms of the 15 performance measures that achieved targets, these were indicative of areas we're progressing or continue to do well in. Our stormwater and waste results, customer satisfaction for our regulatory services, and our response to noise complaints was maintained. Next slide, please, Hannah. And just a few very brief highlights. So Amate project continues to do well. We've had very strong visitor numbers in our regional parks, and Long Bay and our botanic gardens are a particular favourite. In terms of the Kaipara Moana, the project strives for the protection of Kaipara Moana to ensure the waterways and wetlands of the catchment are healthy and enhanced. Stage 1 of that project was completed as well. So that's just a brief on some of the performance measures and highlights. If I could please invite Claudia. Thank you.
Kia ora koutou katoa. Lovely to spend some time with you today to be able to give you an update on customer and community services for the last quarter. And I will also talk briefly about some of the future trends that we're starting to observe and how we may need to respond. If you can please move to the next slide. So this slide here briefly highlights the financial performance for Q2. So what you can see is actually a very strong performance for our operating expense management. As at December, we were 14 million underspend for our operating expenses, and that also includes a $6 million contribution that we had already made towards our organisational savings at that stage. So the total underspend as at December was 20 million. We're forecasting a slightly lower amount of underspend, and that is simply because some of the underspend is related to items that we're deferring and it's a timing issue, but also we need to be conservative and ensure that we're still conducting some of the mahi underway. We also want to be very sensitive that we still have potential ongoing COVID risks, and I will talk to those soon. So we need to be mindful about making sure we're not being too over-optimistic. The challenge that we have is in the Capex space, and you can see that as at December, our Capex performance was 30 million underspend. So that's about 12% of our total budget. It's important to note that half of that is related to a deferred land acquisition. So 15 million or so is actually related to true Capex projects. We are mindful, though, that the ongoing impacts of Omicron could continue to impact our capital spend, as could the supply chain and other items such as inflationary pressures. So we're currently forecasting an underspend in our capital space of 46 million, which is unfortunately an 18% of our total budget being in the order of 260 million per year. Some of those programs are likely to carry forward, and what our teams are working on is that they're currently compiling the potential carry forward programs, and all of those items, I believe, are going to be coming to F&P in May. Next slide, please. So this shows you some of the impacts of COVID on our facilities utilisation. So this chart has lots of lines, but fundamentally it splits the last year or so into 4 different time zones. You have the pre-COVID utilisation rate, the light blue line being of our libraries, the dark blue line of active recreation, and the red of our parks. And then the B slot talks about the first lockdown, where you can see a really marked decline in attendance to almost all of our services. C talks a little about our recovery period, and D is the Delta outbreak implications on our services. Now, what is interesting to note is that after the first lockdown, our recovery period for our facilities was still quite low relative to pre-COVID utilisation. And fundamentally, we observed that our libraries, as well as our active rec, pools and leisure facilities, experienced between a 23 to 25% ongoing reduction in utilisation. When we then went into Delta, we saw a marked increase in parks utilisation, which is what Karuna also just mentioned. But of course, that naturally had an impact on our facility utilisation as well. And currently, the facility utilisation, for example, for our pools and leisure, is sitting at 57% lower than what we would traditionally expect. We will need to be very mindful about what this may mean for future utilisation of our services, and I will be talking to that shortly. Next slide, please. This shows that as a result of the declining utilisation, we have seen a financial impact. What you're seeing here is the actual versus budgeted net OPEX. So the actual is the light blue, and the dark blue is the budget, and these are cumulative over time. The lines I would like to refer you to, though, are the green and the red lines. Now, there's both a positive and a negative story in this. The red line shows the forecast net revenue impact that we're anticipating by year end. So that looks to be around an 80% reduced revenue rate for our council services and customer and community. Conversely, however, because of really tight cost controls, our net OPEX, which is the green line, is actually staying fairly stable. And that is because we're trying to closely manage the risks in our revenue reduction with very tight cost control so that we can protect ultimately the financial well-being of council. Next slide, please. I've shown here some of our non-financial LTP measures, and as these are all largely related to customer utilisation at our service sites, you will see that all of these targets have not been met. And fundamentally, this is because people have not been able to attend our sites or our services, or we've had to conduct our services in different ways. We've, for example, for our leisure centres, have been providing services outdoors. And for some of our other services, we've had to shift to a more digital solution, such as for our events. Next slide, please. This slide here gives you a sample of some of the digital changes that we've been observing. And due to the scale of the axes, the black line may not look as big as what we are observing. However, we have seen an almost 100,000 increase in utilisation for the library's e-issues during the last year or so. The brown line shows the library's website visits, and that is somewhat mixed in terms of why people visit the website. Sometimes it can be to see if the library is open, but you can see some changes in that as well. And fundamentally, what we're trying to show with these slides is that we are seeing a shift in some of our customer behaviour, where they're looking to use, or they are already using, some of our digital sites more actively, and they're interested in doing so more. Next slide, please. This is also shown by this slide here, and there's lots of lines on it, but the key message to note is that some of our website activity is because people are trying to understand about our services, what is open, and what might be available to them in the near future. Others, however, might be related to a greater utilisation by customers overall. So, for example, the Auckland Paths website, which is a digital website that people can use to understand the services available to them, that has seen a very active customer utilisation over the last few months. We're going to continue to monitor these digital uptakes over the next few months quite closely. We really believe that there's an opportunity here for council to adapt some of our services so that we can better meet the customer needs. Next slide, please. In terms of Capex, this slide here summarises the Capex challenges that we have faced and that we're anticipating we will continue to face. And the red line again shows the forecast Capex as a % of budget by year end. The challenge with that is there are some things that we can do at Council, and we are already doing, to make sure we can maximise our Capex spend in line with expectations. There are, however, some uncertainties, and the uncertainties exist regarding supply chain, workforce capacity, particularly during Omicron, as well as inflationary pressures that we're starting to see. Next slide, please. In terms of the Omicron pressures, we, as you may have been aware from our communications over the last few months, we have seen service impacts. And overall, I've actually been very impressed with the agility of all of our teams and all of our services. When we've had an impact, it's been short-lived. And the good news is that based on early data that we've seen just from the last few days ago, it looks as if we're over that Omicron hump and that the impact on our services is declining. However, as at the 9th of March, we had 33 sites that were affected, and many of those were understandably our pools and leisure centres as well as our libraries. Next slide, please. It is not all doom and gloom. We've actually had a lot of successes during the last half year, and I would like to acknowledge all of our teams and all of our elected members who also supported our teams during this time. There are a number of large-scale successes, and this only shows some highlights. What I'd like to particularly point out is that we had successes in meeting and potentially exceeding the savings targets that Council has set for this year, so that we can make sure that we continue to have really strong financial sustainability. The other aspect that I think our teams can be very proud of is our agility and our ability to adapt to the Omicron and previously the Delta outbreaks. These were highly uncertain times that required a strong amount of collaboration, but our teams also adapted. They have identified new ways of delivering customer services, including digitally, such as giving citizenship ceremonies online and providing events such as Music in the Parks online now. That way, our teams can continue to contribute to the well-being of our communities and continue to contribute to the economic recovery. I would also like to give a big acknowledgement to the Amotai team. That work has done a lot in terms of putting focus on the communities who may need us most, particularly around Māori and Pacifica employment, and making sure that we can support those who are most disadvantaged. Next slide, please. We have a large number of mitigations in place, and I know that our teams are all very focused on making sure that we can ride through these uncertainties as best as possible. There are 4 key areas that we will need to very closely monitor this next 6 months, but also over the coming few years. 1, these are the macroeconomic shifts that we're all aware of. So this includes inflationary pressures, workforce shortages, and supply chain risks. Given the COVID environment, we may also have further potential closures, which may affect our revenue. We're also anticipating some changing customer behaviours. And we will be looking not only locally in terms of customer data, utilisation data at our sites, digital uptake data, but we will also be looking internationally to understand from those countries that are a little bit ahead of New Zealand in terms of their COVID outbreak, what this may have meant for their services and how we may need to adapt at Council. And last but not least, we still continue to face potential staff shortages. And so those are things that we're really closely monitoring. And of course, we want to make sure that we retain as many of our excellent staff as possible. Next slide, please. So in terms of managing these key risks, on the left-hand side, those bubbles largely refer to items that we within our operational teams can directly manage and are working on. So to mitigate the risks around revenue shortfalls and inflationary pressures, we are recommending that we continue to focus on operational excellence and efficiencies. For example, where we can, we should continue to focus on a digital-first strategy so that we can direct customers to more convenient, lower-cost solutions where that is appropriate. We should also be looking at revenue growth opportunities and driving revenue growth where we can and where it's safe to do so. For example, with marketing campaigns in pools and leisure or for our libraries attendances. But we should also be looking at revenue growth in terms of how we may need to pivot our services. If, for example, people are not utilising our indoor pools and leisure spaces, do we need to look at how we offer alternative solutions in the outdoors while also protecting our revenue position? And last but not least relates to economies of scale. Our directorate is a large directorate and our teams have done a lot of excellent work over the last few years to make sure we're as collaborative as possible, we minimise duplication and we maximise each other's expertise. We would really like to continue that, and we're continuing to do work across our directorate and including with other directorates to make sure that we're utilising our valued and highly skilled resources in the most effective ways. That also applies to procurement, and we've already applied a number of procurement strategies to be able to ease the Capex programs, to make those faster to implement. And we continue to see that there will be some improvements in that space. However, it may take a little bit longer for those to take effect. Now, in terms of the other opportunities that may particularly require greater engagement with our elected members, continues to be the focus on capital spend that you've just heard about, and also some of the LTP recommendations that we made last year. And those LTP recommendations affect our asset-based services. And we still continue to have the Section 17A reviews that are underway. And the Section 17A reviews that we're currently working on is that for pools and leisure. These items and any recommendations that come from those analyses will be coming to elected members, and we may have recommendations for how we can more effectively spend our capital spending capabilities, what we may need to deprioritise, or other recommendations based on what we're seeing with customer trends. It is important that we stay agile, because the more agile we can be, the more we can protect Council's financial position. Thank you very much for your time, and I'm very happy to take any questions.
Thank you very much. It's a large presentation and a lot to take in, and there's good news and some cautionary news. I have 3 questions so far, Councillor Cooper, Councillor Walker and the Deputy Mayor. Councillor Cooper, you first.
Quickly remember what my questions were. So this is for the whole presentation, right? Because I had some questions, I think, for John, the finance team, around the sustainable link loan. Okay. So is going into that loan, is that assumed, like the benefits has been assumed around having or actually having the climate action targeted rate money available, or without that?
Through you, Madam Chair, it's a difficult one to answer directly. whether it assumes that or not. We might have. I've got Helen Mahoney on the line or not, whether she can add anything to that. But these targets have been, formulated in association with the business to what we can achieve. But they are stretch targets. They're not sort of easy ones that we can easily achieve. So they're stretch targets, which is generally going to rely on funding going into things which support strong, sustainable, and social outcomes.
Okay, so I guess that means sort of we need that, don't we? And the other question was around staff. Like, it looks like the increases, are they a rebound response to when we cut staff by 5%? Because I look at it and it's all the core stuff we do, and now we need the staff again. To me, it doesn't seem a surprise that that's happening, given we're low in staff. Because I'm asking because often we've got this public perception that we're sort of over flush with staff, but we cut right across the board 5%, and now we're looking, well, we're increasing again in the places that are really needed, like the ports, like regulatory, when we've cut them back, and now, I don't know, maybe a year's respite, but the reality is we still need them. Would that be a rebound response to having those cuts in the first place, as well as increased need?
Ross, I was looking for you to answer that one, maybe.
I'll give it a go. Others can jump in. I guess there's lots of things going on there. I don't think that's the primary response is we cut staff and then we've let people go and now we've got to rehire them. I think there's a number of things going on there. We largely, let staff go because we found more efficient ways to do things, or we took different decisions about services. So those don't change. Some of it is filling vacancies in ports and other places where if you don't have people, and we've experienced, most organisations experience lots of people leaving, and we've got to fill vacancies. So you will have seen over the last year or so a dip in numbers as people leave and haven't been replaced because you just can't find people. And so what we saw towards the second half of the last calendar year was filling some of those vacancies because we finally managed to get people for those roles. Some of the things, particularly in Auckland transport space, one of the things I've called out consistently is, the size of the capital program, the nature of the projects determines how many people they have. And the best thing for them is, certainty around the size of the capital program, and then they can make sure they build up, a team of delivery people consistently. If you have to keep chopping and changing your delivery staff as the Capex funding comes and goes, it gets really challenging. So there's a number of complex things in there. I don't think it's a direct response of we cut staff and now we're having to reverse that. I think there's a range of other factors going on.
Thank you, and I guess it's the same for water care. Just another question, if you'll indulge, Madam Chair, Claudia, is when you talk about offering other services, I see with the website visits, it was a lot around our sport and leisure, so I imagine a lot about when are the swimming pools open, those sorts of things, and we can't deliver that online. When you say other options, would it, for example, partnering with schools who have outdoor pools or that kind of way of delivering water? Or do you want us to have a conversation about this at another time at a workshop?
Yeah, Linda, sorry.
Okay, no, that's fine.
Here, can I just say can we just leave that? Hold that thought, Councillor.
Thank you. Thanks.
Thank you. Councillor Walker.
Sure. Got a few questions. Got a question first that just follows on from Councillor Cooper around the sustainability-linked loans. They're linked to emissions reduction. Would I be correct in assuming that the emissions reductions are Auckland Council group reductions, not Auckland reductions? Because obviously we have a climate target for Auckland as compared to Auckland Council.
Yeah. Oh, sorry, you go, Helen.
Yeah, I can answer that one through the chair. So the greenhouse gas emission target that's linked to our sustainability linked loan is just for the council group. It's not related to our regional emissions. And in response to Councillor Cooper's question earlier, the target, the greenhouse gas emission target doesn't take into account any activity that's been funded under the climate action targeted rate.
Okay, well that's fine. I've got a few other questions, and if it's okay, I'll just group them together because a number of them are related and they're topical. I would make the assumption at this point in time that any activities, any interaction that we've got with Russia, as it might go to various people associated with Russia buying bonds, any importation that we've got from Russia, anything in that sphere of activity generally is being closely monitored. So I'll just leave that question for a moment so that you can think about it, and I'll just go along onto a few related issues. Conversely, if there is anything whatever that we can support Ukraine around, there will be Ukrainian refugees coming to New Zealand. Many of those people are professional. They have a high degree of competency. A number of them can speak English and the like. If there is any opportunity that we as Auckland Council can do to provide support there, that would be highly desirable. The other related issue goes to our dependency on oil. Quite obviously, that is a global issue right now. I'm not certain where New Zealand's oil imports come from, but obviously you've got a global mix there. And anything that we can do as a council to lead reductions in oil consumption, to radicalise our shift to electric vehicles, which are much more economical, would be highly useful. So that's just a grouping of questions I've got that all go to the issue around Russia and Ukraine, which I think is not just here for the short term, but frankly will be around for the medium to long term in terms of its effects. So I'd just invite a response there. Thanks.
Can I just help staff here a bit, Councillor? Those questions are not direct questions for this item, which is the response, the result of our 6-month financial report for the period of 31st of December. But I think it's something that is a decision, is questions that you've asked are relevant and everyone would like to know. And may I ask that staff that we make an appropriate time to answer those questions? Thank you.
Okay. The other question I've got just goes to the figures that you put up around building consents. I'm not sure what the situation is around resource consents, but the feedback that I get from people that work in this area in the community is quite severe in terms of the duration of time that that is occurring and the impact on businesses. I mean, to the tune of months and months that people are waiting. So I don't necessarily need a detailed response now, but I think there's a huge amount of urgency around that, because I would suggest that circumstance could and will escalate with the draconian changes that the government is making around urban densities and the like. That will actually start biting soon. So I don't know whether you want to generate a response, but Madam Chair, I am indicating that is something that we need to pay a lot of attention to, and as councillors I think it's vital that we have more oversight over that as soon as we can.
Thank you, Councillor. And again, I don't want to I want to protect staff a bit and just note that will be covered in the regulatory meeting. They have supplied a result as per the 31st of December. Deputy Mayor, your question, please. Sorry.
Just supplementary, Madam Chair. I mean, I know that the Regulatory Committee contains a relatively limited number of councillors, but this issue is of such magnitude that it really needs to be go to the governing body or the like. I know there's a huge concern around the development community over this issue, Madam Chair. Thank you. That's all from me.
I can probably respond, at least in a partial sense, to that, Councillor Walker. That's around the performance measures that are reported in the pack under regulatory services. That's page 131 of the material on Nexus, I believe. So that does outline where it's been achieved, where it's not been achieved, what the statutory requirements are, and where work is ongoing to lift that up as well. So that's probably not going to answer the full question, which would need to go to that regulatory committee, but it is the performance metrics feedback that's there.
Thank you, Peter. Deputy Mayor.
Thanks, Madam Chair. I got one question for John and one for Nicola. First one, John, when you talked about the delivery of the capital program, we were, make my notes here, we were at high 60s%, I think, from memory. 62, yeah. Is that in dollars and cents, or is that in the actual projects themselves? And if it's in dollars and cents, what is the actual projects themselves, given that they're having materials and construction cost increases?
Through you, Manager, I think it's probably is it a Ross Tucker question? You're talking about capital expenditure delivery?
Yes, that's correct. The Capex delivery program, yeah.
Yeah. It's
Ross?
probably
Okay, sorry.
direct before to Ross.
Yeah, so what we're reporting on there is how much did we spend compared to budget, and so the results there show you what we spent compared to budget. So some of that, the big driver there is a whole lot less than budget, and that is because of the lower delivery. To some extent, we'll be chewing through more dollars because some of the prices are going up. So we're starting to see that bite and starting to have that come through. I think that some of that will come through more over time. Some of it will be contractor claims that come through after the event, beyond the lockdown period. Others were, it'll be projects that that come through. Don't have any specific dollar amounts. I mean, a lot of the projects that are underway in construction that occurred over the last quarter would have been ones contracted earlier. So it's kind of as we contract things now is where things hit, but also as people, as costs go up and people run into difficulties, we get supplier claims through lockdown. So there's quite a lot going on there. We don't have specific numbers yet in terms of how much of the Capex is cost, it's price factors as opposed to volume and delivery factors. I mean, that will take a bit more time to analyse some of that stuff, and I think something we can look at as we get through the rest of the financial year, so that by year end we have a clearer picture, not just about the quantum, but the impact of pricing. We do know that going forward, those things are becoming more and more challenging.
Yes, thanks, Ross. That's exactly the answer I was looking for. So for every dollar we spend, we might only get 80 cents worth of actual project on the ground as these inflationary hits accumulate. So thanks. To Nicola, the question was about the target savings. So you've made about 72% this financial year to date, a bit more to go, but it's going to get harder over the next 2 or 3 years. Is that still a realistic target, do you think?
Thank you for your question, Councillor Cashmore. That is a tough one to answer. I think it is going to be challenging, and you've seen the information that's come out in the consultation budget the consultation document relating to the challenges that we have with our finances in the future, and that'll be updated in your workshops coming up. It is difficult to find savings that are reducing costs and improving our efficiencies, but we are up for the challenge, and we've got a value for money program. We're embarking on, Claudia mentioned revenue projects, which we're looking at organisation wide as well as just in customer and community services. So we do have a few leads and ideas, but yeah, it's not meant to be easy. It's meant to challenge us, and we'll keep you posted.
Thanks, Lee. I think that's a critical point, because there's no sense having these aspirational budget savings set at a point that are non-achievable, because then we'll have false budgets going forward that won't be portraying the reality. So, yeah, please keep us well informed. Much appreciated.
Thanks for that, Bill. Councillor Coombe.
Kia ora, Chair. Tēnā koutou, ngā mihi nui ki a koutou. Thank you for the report and the presentation. I think it's really good to have such a fulsome presentation that can be publicly facing and explained to the public. So I presume the presentation will be incorporated into the minutes, which would be fantastic. I have a bit of a potpourri of questions, if I may, Madam Chair. The first one is to Mr. Bishop around the sustainable link loans, and I just wondered, is this distinct from the sustainability link derivatives, which I understand is this happened in the latest quarter, so it's not being reported on in this current report. Is that right? Am I understanding that that's right, that they're two different things? Because I see that Auckland Council's getting some accolades for the sustainability linked derivatives as being the first council in New Zealand to put those in place.
Yeah, through you, Chair. So yeah, both of these are subsequent to 31 December, so they've happened in this quarter. And yeah, we are the first council to do a sustainability linked derivative, and probably the second organisation in New Zealand. We're beaten by a week by another organisation, which is actually owned offshore. So we're probably the first, at least New Zealand owned organisation to do one.
Oh, great. That's really good to hear.
That'll be a highlight for next quarter.
Yeah. Oh, that's good to know. And I mean, I'm just really keen to understand more about how this is, part of our sustainability targets for another day. But thank you for that work on that. Sounds really innovative. My second partai is around is regards to libraries, and the fact that we're below 35k below target for our library users. And I think it is mentioned in the report. I mean, obviously, I do acknowledge across all of this has been massive impacts with COVID and lockdowns. But I just wonder, have we not yet seen the benefit of removing the library fines, and have we just not been able to yet really ramp up a really good kind of promotion around coming back to your library? And is that kind of having an impact on that number?
So kia ora, Councillor Coombe, thank you for the question. So through the chair, I think it's too premature to say whether or not the marketing effects that we're currently launching to return back to the libraries is having an effect or will have an effect. It is currently underway. It has recently been launched. We have to be mindful of the Omicron situation and staffing shortages. So we didn't want to essentially overpromise and underdeliver, for example, during this time where we did have some staffing uncertainties. So, and I think it's also too soon to understand whether or not the library fine situation is going to result in a change in utilisation. There are two things here that we need to be mindful of. There's probably the direct short-term implications of people attending our facilities, and that will change and is expected to change as a result of COVID, as people did lose some confidence of going into public places. The long-term effects, though, is the aspect that we need to be mindful about, and that's where we can really look at how our marketing influences attendance rates, and also how the library fines reduction influences attendance rates. So we're too soon to be able to say whether or not they're making a difference right now, I'm afraid. Mm-hmm. We can certainly continue to give an update, and probably at that next quarterly report might be a really good time for us to do a bit of an update to see if we're seeing any changes to those trends. Thank you.
Kia ora, thank you, Claudia. And I know cities all around New Zealand are following Auckland's lead on removing library fines, so it's great mahi there. And just finally, Chair, just a very quick one, and I know in the scheme of things this is minor and there's a whole lot that's being reported on and big challenges, but there was a request, I think it was at the last quarterly report, that we have reporting back on the uptake of outside dining licenses, and just whether we're seeing any kind of positive impact with the decisions that we made about removing the fees for extending outside dining. So I couldn't find it anywhere in the report, and I just wondered if that had dropped off or we were going to have it reported to us some other way.
Peter, did that go to regulatory? Or
I'm afraid I don't recall that at all. I'll have to chase that one up.
we'll come back to you, Pippa. Thanks for the reminder. Thank you.
Thank you. Thanks, Chair. That's all of my questions, and great to see your recommendations.
Thanks. I've got them up so people can read them. There's nothing that's not in the report, but I'm highlighting the positive and noting the concerns. Councillor Sayers.
Thank you, Chair. I had just a few questions for the Treasurer and also for Ross. Is John still? Yeah, John's still with us. I can see you there, John. Hey, you went through the debt with us, John. I haven't got that up on the screen at the moment. What's the debt? What was the change in the debt, and where are we sitting at the moment?
So through you, Chair. So the change in debt. This is our net debt. So your gross debt, taking off our cash we hold. That's gone up to 10.5 billion as at 31 December 2021. That's up, I think, it was 108 million from the end of June 21.
Okay, John, thanks. Okay, and now in terms of servicing that debt, John, I just wanted to ask you a question around how much do we pay to service that debt on a daily basis? Have you got an idea of what our cost there is?
The ballpark, our interest bill is sort of around, call it $450 million a year. So what's that? It's about 1.3 million per day.
Okay, and of that, say 1.3, how much of that is interest and how much of that is principal?
That's just interest.
Okay.
Because our debt level is still growing. So when our tranches of debt mature, we are renewing them. So we're not repaying any principal.
Right. And so can you just, I guess that just leads to the question, can you just explain to us why, could you expand that for us, John? Why aren't we paying principal on it? And at what point in time do we start paying principal?
Okay. So the reason we're not paying principal back is that obviously the city's still growing and we're investing in a lot of capital expenditure. So if you look at our long-term plan forecast, it has our debt going to just over 16 billion and has our assets growing through our capital investment from its current level at around about 55 billion to about 90 billion. Now, if you look at what makes up how our debt grows, it's going to grow by smaller and smaller amounts based on our forecasts at the moment each year. That's because we generate bigger and bigger operating cash flows through the long-term plan, and that's because we essentially move to fully funding depreciation, which is a non-cash cost in our operating budget. But obviously that difference or that cash that we generate can go towards the capital investment, so we're less reliant on debt. But debt is still forecast to grow each year for the remainder of the long-term plan, but by lowering amounts each year.
Okay, so I'm just trying to I understand that answer, John, but in terms of, if you could just help me in terms of timeline. So when we get to that situation where it keeps diminishing and we get to that, I guess, cash flow positive, for want of a better word, situation, what is that projected for where we could make the decision to pay off principal?
I mean, that's not projected in this long-term plan, which goes out to 2031. So that's very much going to depend on the next long-term plan, which Council's put in place in 2 to 3 years' time, and what decisions Councils make on things like revenue levels, expenditure, capital expenditure, etc.
Okay. So I might just add a bit of a clarification there, if I could. We get to a balanced budget under the long-term plan around about 27, 28, but we continue to increase our gross debt levels over that time. The main purpose of debt, of course, is around intergenerational equity. So you're spreading the cost of what is built over the period of the time of the users of that asset. So it's actually that relationship which is really important as well.
Yeah, and I'll just add to help you, Greg, too. You know, you can't say that our debt is bad, because if it wasn't right, if our debt was too big or out of control or whatever, we wouldn't maintain the credit ratings from both the two major rating agencies. And I think that's really key. It is eye-wateringly large. You know, debt is eye-wateringly large for most people, but the percentage of our debt to assets is under 20%, and we still maintain the highest rating of any council in New Zealand.
Okay.
You had a question for Ross too, I think, didn't you?
Well, I might, while Peter's there, I might just Peter. So would it be financially prudent for the Auckland Council in 2028 to consider paying principal as well as interest?
Through you, Madam Chair. The relationship's somewhat more complicated than that. It's really around the investment in infrastructure that's required and the life of that infrastructure and the period of time over which you need to pay that off. So it's not quite as simple a relationship. But maintaining the commitment to that balanced budget is crucial.
Okay, yeah. Thanks, Peter. So it'd be fair to say that we haven't got a plan to pay off the principal or to go into a situation paying off principal as well as interest for the reasons that you've outlined.
No, I don't think that would be fair through you, Chair. I think that would be a misrepresentation of what I just said, which is it's a very complicated relationship, and we shouldn't just look at that one aspect of it. It's really around delivering over the generational aspects of the users of the infrastructural assets.
Yeah. Okay, thanks, Peter. Thank you, gentlemen. I did have some questions that, through you, Chair, maybe Mr. Tucker that wants to answer them. So it's really, Ross, it's really a 101 question in terms of budgets, and probably more specifically, my questions around the line items within our budgets. How you would explain to councillors are they their purpose, so those line item purpose, are they targets, are they guidelines? What's your definition of a budget line item in that general sense?
I guess at the most sort of basic level, why do we have budgets in our annual plan and long-term plan? It's, I guess, we operate within the the context of the Local Government Act, which kind of says you've got to set out your intentions to spend money, define the services, assets you're going to provide, and outline how you intend to pay for it. So the budgets are there to represent an intention to invest in services and assets. And it determines, the funding sources. So it's there to, provide community transparency in terms of where the money goes and how we pay for it. So the budget, supports our rates collection and setting rates, whether it's targeted rates, general rates, development contributions, use of borrowings, all those things. So the budgets are there to ensure that we have the money available to provide the services and have the means to pay for it. If we exceed budgets, and if you see us through these quarterly reports showing that we've got less revenue coming in or more money going out, it's going to be tougher and tougher to keep delivering those services. And at some point we have to revisit those funding parameters, such as rates or debt or whatever. So I think, to me, that's sort of the core purpose. I hope that helps answer your question.
No, Councillor, respectfully, if you want to ask general finance questions, this isn't the item to do that. This is about the results, the second quarter results, all right?
I'll ask a question about the results then, Madam Chair. Anyway, thank you, Ross, for that explanation. It did answer my question. Thank you. So it's around the slide around the FTEs over the last 6 months. I think I noted on that slide they were up 380 or 381 FTE at that period. That obviously would have a ongoing effect into the reporting item around salaries and benefits. So the question is, what in terms of the budget for the line item for remuneration and benefits for council group, Are you able to comment if we're ahead of budget there, on budget or under budget in terms of that remuneration line item, please?
It's for the group, we were 17 million over budget on employee benefits for that 6-month period. Period was within budget. The biggest driver was water care, and a lot of that was overtime cost that we had. Where water care had to have extra shifts of people to maintain social distance as they kept essential services going. Sometimes some of the FTEs come with extra revenue, such as the ports or things like that. Things in the regulatory space, you have extra people and extra revenue that goes with it. But in terms of the employee benefits line, 17 million above budget, off a budget of over $500 million. So it's a small variance percentage-wise, and water care was the biggest part of that.
Okay, Ross, and could I just, final question would be, say, for the parent Auckland Council itself, because obviously we've had explained to us the difficulty to recruit and retain staff, and so for the parent, the same question, Ross, where are we sitting there in terms of that line item being under, over, or on target?
I might just ask Nicola to answer that question.
Okay, thank you.
Thanks, Ross. We are under our budgeted level of FTE, so that means we did budget to have more staff than we currently have, and that's one reason that we are in the financial results. You'll see that we are under our staff cost budget as well.
Okay, Nicola, thank you very much. Have you got that at your fingertips here? I'm just trying to find that number in terms of how far under are we?
I don't have the budgeted FTE at my fingertips.
All right, okay, all right, it's available. Okay, well, thank you, Madam Chair, and thank you to the officers for their helpful answers.
Thank you, Councillor. Final question, Councillor Hills.
Good, Madam Chair. I did have some similar questions to Greg, but first the question on the Capex. How quickly, or do we have any idea, and it's impossible probably with supply issues and inflation, but how quickly we will catch up or can catch up? And is the issue that we cannot move a lot of this forward easily into the next budget, or do we feel like we can catch up within this 6 months?
So the latest, we're still working through current year forecasts as part of the annual budget exercise. We do expect to be down. We won't catch up for the full annual budget number. We're so far behind, and there's so many supply chain constraints. We're not going to catch up across the group for this financial year. We're probably going to be slightly down next financial year as well. So even with higher pricing and higher costs, we think there's going to be over the next 12 year to 18 months, there is going to be continued under delivery of the capital program. I think that's pretty much inevitable.
Good, thank you. The other question I had, and they were based before Councillor Sayers asked his, but I guess there is a lot of trouble made with our debt because people believe we're a house that you suddenly need to pay down the debt to nothing because we're all going to retire. But because the council continues forever, could you just explain what it would mean if we were actually going to try reduce our debt? Say we didn't debt fund any of the assets this year. Was it, I think the figure, we'd have to put up rates 50%, 50, this year if we were going to do all our capital without debt funding?
I can't recall the figures off the top of my head, but yes, if it's hundreds of millions of dollars, it is. If we were to run if we wanted to pay down debt significantly, you'd have to stop a whole bunch of capital investment or massively put up rates to continue capital investment without the use of debt. So I guess that those are all the levers we work through. What's the level of capital investment? What's the level of rates? What's the level of borrowings? If you sort of move one lever, such as borrowings, in the opposite direction, it's going to have a major impact on the other levers.
So essentially the two things that matter most is that the debt to revenue ratio, which was still under forecast, and the net debt to asset ratio, which has kind of been moving in the 17, 18% for the last 5 or 6 years. So essentially our debt is stagnant based on assets.
I think that those are the key things. I guess the other thing is, what is the debt for? If it's borrowing and investing in infrastructure that's supporting the growing city, it's growth infrastructure that's going to be there for a long time. Well, then that is a prudent way to manage the council's finances, and it's exactly the stuff that our rating agencies look at. What is the debt being used for? Is it building quality investments and assets for the future?
And the public would need to know, if we were not going to add debt this year, we'd have to put up our rates 50%. To cover the current capital investment.
Something like that.
Something like that. Some would have to be significant trade-offs.
Yeah, cool. Thank you.
Thank you. Look, I've got no further questions and I don't have any comment now. 3-second rule. No, look, I just want to draw everyone's attention to the Chair's Recs I put up. They are all taken direct from the report, but they do cover some things that I think is important, and that's the uncertainty and disruption of COVID-19, the investment that we've actually made for the period, our debt, and the fact that although it's gone up, it's okay. And the highlight actually for me is the green bonds. The fact that our revenue is down, our expenditure is favourable, but actually that's due to work delay, and the progress on savings. So to that end, I'm happy to move those recommendations and ask the Deputy Chair to second. Okay, and with no comments, I'm happy to take this to the vote. All those in favour say aye.
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 Against?
Aye.
Carried. Thank you. Members, I'm very conscious that it's 2 o'clock.